The first confirmed United States bank failure of 2026 deserves careful attention today. It matters not because panic erupted, but because almost nothing visibly happened here. Regulators quietly resolved the institution without headlines, runs deposit freezes, or emergency measures. Customers retained uninterrupted access to funds, reinforcing confidence through design rather than luck. Such calm outcomes are intentional, reflecting modern regulatory frameworks shaped after past crises. Stability today often masks pressure accumulating quietly within weaker balance sheets nationwide globally. This failure involved a small regional bank operating under tightening financial conditions recently. Smaller institutions usually reveal systemic stress earlier due to limited buffers and concentration risks. Regulators cited unsafe and unsound conditions, language signaling serious deterioration beyond recovery capacity. Such terminology indicates capital adequacy, liquidity, resilience, and governance standards failed simultaneously internally. Bank failures rarely occur suddenly. They develop gradually as risks compound unnoticed externally. Higher interest rates have restructured banking risk profiles in complex, often underestimated ways. Rising yields compress asset values, while deposit competition simultaneously increases funding costs pressures. Large, diversified banks absorb these forces. Smaller banks experience destabilizing margin erosion effects. Over time, weakened capital ratios attract scrutiny, triggering supervisory escalation and eventual intervention. Resolution mechanisms aim preventing contagion by isolating failures before confidence evaporates nationwide markets. Deposit insurance funds exist to preserve trust, yet our finite cumulative drawdowns matter. Each controlled failure tests assumptions about resilience without provoking immediate public alarm responses. The affected bank operated decades expanding geographically, yet remained vulnerable to tightening cycles. Longevity does not guarantee durability, especially during synchronized macroeconomic policy shifts periods globally. Illinois history shows repeated bank failures, demonstrating localized vulnerabilities persist across cycles decades. Modern resolutions appear orderly precisely to avoid panic and prevent destabilizing deposit runs. Low failure counts annually do not imply safety, but controlled stress distribution mechanisms. Current conditions represent a prolonged stress test rather than acute crisis moment phase. First failures carry symbolic weight, refocusing investors, regulators, and depositors, attention nationwide simultaneously. They raise unavoidable questions regarding isolation versus emerging trends beneath surfaces financial systems. Authorities responded efficiently, demonstrating preparedness rather than improvisation under pressure conditions nationwide today. Services resumed seamlessly, no extraordinary guarantees, signaling confidence and containment capabilities across markets. Yet the underlying message remains smaller banks face heightened vulnerability today nationwide conditions. Higher rates, tighter liquidity, slower growth amplify sensitivity to shocks across banking sectors. Systems can absorb isolated failures, but cumulative stress challenges broader stability thresholds eventually. Ignoring early signals risks misjudging scale timing and transmission pathways across markets globally. The absence of drama should not be mistaken for absence of risk signals. Preparation and quiet action often precede larger financial adjustments across cycles historically observed. This event offers insight into contemporary American finance, more than sensational headlines ever. Controlled handoffs reveal fragility managed rather than eliminated entirely within banking systems today. Understanding these dynamics requires patience, context, and attention to incremental change across cycles. The first failure marks a reference point, not a conclusion within ongoing processes. Future developments will determine whether pressure remains contained or broadens across institutions nationwide. For now, the system appears orderly, but caution remains warranted among observers everywhere. Financial history suggests early warnings often appear benign before accelerating rapidly across sectors. Participants should evaluate balance sheet sensitivity rather than headline reassurance from officials alone. Liquidity management, capital adequacy, and asset duration remain critical variables for survival today. Macroeconomic tightening exposes mismatches created during prolonged low-rate periods across banks nationwide. Resolution frameworks function best when invoked early, decisively, and predictably by authorities globally. Confidence depends on transparency, consistency, and demonstrated operational competence across institutions, markets broadly. This episode underscores why monitoring smaller banks remains essential for systemic health assessments. Size amplifies vulnerability when shocks concentrate funding and valuation pressures across segments unevenly. Orderly resolutions should not breed complacency among stakeholders, including investors, depositors, regulators alike. Banking systems evolve, adapting safeguards while confronting new risk configurations over time continually. Each failure contributes data informing supervisory models and policy calibration for future responses. Signals accumulate, gradually shaping expectations long before consensus shifts among market participants widely. Public narratives often lag internal assessments by months or years within institutions globally. Therefore, vigilance matters even during periods of apparent calm across financial landscapes today. Stress transmission paths differ from prior crises, demanding analytical frameworks for policymakers now. Gradual resolution strategies trade speed for discretion and confidence preservation within banking systems. Such strategies succeed until overlapping stresses exceed absorptive capacity of institutions involved simultaneously. The question remains, how many institutions face similar silent pressure today, nationwide, potentially? Monitoring funding costs, asset values, and capital buffers provides clues for analysts' observers. Interest rate trajectories will continue influencing bank stability outcomes across regions, sectors broadly. Economic slowing compounds risk by weakening borrower repayment capacity across loan portfolios widely. Prudent interpretation avoids panic, while recognizing non-zero probabilities of escalation scenarios ahead, globally. Regulatory readiness remains a stabilizing force under uncertain conditions within financial systems today. Yet readiness does not eliminate underlying economic constraints facing institutions, markets, households alike. Failures resolved quietly still represent losses absorbed somewhere within system balance sheets eventually. Deposit insurance spreads costs collectively, reinforcing trust through mutualization mechanisms, supporting stability nationwide. Sustained drawdowns may influence premiums policies and political scrutiny over time periods ahead. Thus, early contained failures warrant analysis rather than dismissal by serious observers everywhere. Financial systems reveal stress through process long before collapse becomes visible, publicly dramatic. This episode exemplifies that principle with clarity for analysts, policymakers, investors alike today. Interpreting signals accurately supports better risk management decisions across portfolios, institutions, strategies worldwide. The year's first failure frames expectations for subsequent monitoring efforts across sectors nationally. No single event defines trajectory, but patterns emerge cumulatively through repetition observation cycles. Attention now shifts toward identifying where pressures concentrate next within financial networks potentially. Cautious analysis today may prevent surprise tomorrow for stakeholders, policymakers, regulators, investors alike. The calm resolution should encourage vigilance, not complacency among market participants, observers everywhere. Understanding slow stress dynamics remains essential for navigating modern finance systems risks effectively. This narrative continues as conditions evolve and data accumulates across quarters, cycles ahead. The broader implication of this failure lies within cumulative pressure building across banking layers. Financial stress today propagates through balance sheets rather than headlines requiring analytical patience. Banks operate within interconnected funding ecosystems, sensitive to rates, liquidity confidence cycles. When monetary conditions tighten uniformly, weaker nodes reveal strain earlier than dominant institutions. This does not imply imminent collapse, but highlights uneven adaptability across banking structures. Higher borrowing costs affect loan demand, credit quality, and refinancing behavior simultaneously nationwide. As growth moderates, borrower resilience weakens, impacting asset performance across portfolios steadily. Banks holding concentrated exposures feel these shifts faster than diversified competitors generally. Liquidity remains adequate system-wide, yet distribution matters more than aggregate totals. Some institutions face elevated deposit sensitivity as customers seek higher yields elsewhere. This competitive environment compresses margins, forcing strategic adjustments under regulatory observation. Regulators monitor trends, emphasizing forward-looking assessments rather than reactive crisis responses. Supervisory actions increase, gradually beginning with inquiries, guidance, and corrective requirements. Institutions unable to comply eventually face resolution to protect depositors' stability. This framework aims reducing contagion by addressing weakness before panic ignites markets. Such an approach depends heavily on accurate data, timely intervention, and public trust. Trust functions as currency within banking systems, reinforcing stability during stress periods. Deposit insurance supports confidence but relies on prudent risk management practices. If stress broadens insurance mechanisms, face greater scrutiny and potential recalibration. Policy discussions often intensify following early failures as signals gain attention. Stakeholders debate whether observed events represent isolated mismanagement or systemic imbalance. Current evidence suggests pressure concentrated among smaller, less diversified banks. However, economic conditions remain fluid and can shift risk profiles unexpectedly. Interest rate paths, inflation trends, and growth outcomes shape future stability prospects. Banks continuously adjust asset duration hedging and funding strategies accordingly. Those adjustments incur costs and execution risk affecting near-term performance. Markets price perceived resilience, rewarding scale diversification and capital strength. Smaller institutions confront higher hurdles raising capital or restructuring operations. Consolidation becomes attractive as a survival strategy within constrained environments. Mergers, acquisitions, and assisted transactions increase during tightening cycles historically. Such outcomes reshape banking landscapes, altering competitive dynamics regionally, nationally. Communities served by smaller banks may experience service transitions gradually. Regulators consider these impacts, balancing stability, competition, and access considerations. Technology adoption also influences adaptability, efficiency, and cost management capabilities. Institutions lagging modernization face additional pressure from operational inefficiencies. Cybersecurity compliance and reporting requirements further raise baseline operating expenses. These structural factors compound financial stress beyond interest rate effects alone. Thus, bank failures reflect multidimensional challenges, not singular events. Analysts evaluate capital ratios, liquidity coverage, earnings stability, and asset quality collectively. No single metric predicts outcomes, but patterns emerge through combined indicators. Forward-looking supervision seeks detecting these patterns, early minimizing disruption. The controlled resolution observed demonstrates preparedness rather than complacency. Yet preparedness assumes limited frequency, manageable scale, and sufficient resources. If macro conditions deteriorate, further resolution capacity may face testing. Therefore, observers track not just failures, but near failures regulatory actions. Public disclosures, earnings calls, and supervisory commentary offer valuable context clues. Investors reassess exposure to regional banking equities and debt instruments. Funding markets adjust pricing to reflect perceived risk differentiation. This repricing influences lending behavior, credit availability, and economic momentum. Feedback loops can amplify stress if confidence erodes too quickly. Policymakers aim moderating these loops through communication and measured responses. Transparency, consistency, and credibility remain essential tools for maintaining stability. Historical experience shows delayed recognition worsens eventual outcomes significantly. Early acknowledgement, controlled action, and gradual adjustment reduce long-term damage. This episode underscores importance of continuous monitoring rather than episodic crisis focus. Banking systems rarely fail suddenly, they deteriorate through stages. Understanding stages helps stakeholders respond proportionately without unnecessary alarm. The first failure of the year establishes a benchmark for vigilance. Subsequent developments will clarify whether stress remains contained or expands. Observers should avoid binary thinking, focusing instead on probability distributions. Financial stability operates on gradients, not absolutes, under dynamic conditions. The environment demands nuanced interpretation, disciplined analysis, and ongoing reassessment. For now, the system demonstrates resilience alongside identifiable vulnerabilities. Both truths coexist and must be evaluated together responsibly. This perspective supports informed decision-making across investment policy and regulation. As conditions evolve, data will refine understanding of underlying pressures. Monitoring continues as part of prudent engagement with modern financial realities. If you find this analysis useful, consider subscribing, sharing, and commenting perspectives below. Your engagement supports deeper discussion around financial stability and risk awareness.